Welcome to episode 2 of our RSI series on TradeX Pro. In this episode, we're diving into the powerful concept of RSI divergence. If you missed our first episode, we covered the fundamentals of the relative strength index and its role in identifying momentum. Today, we'll focus on regular divergence, where price and RSI move in opposite directions. We'll examine both bullish and bearish divergence, exploring how these signals can help you anticipate market shifts. By the end of this episode, you'll gain a clear understanding of how to spot these divergences and integrate them into your trading strategy. Let's dive in. Before we begin, let's explore various scenarios in the stock market. First, we'll examine a bullish market. In a bullish market, the overall sentiment is positive and prices are generally rising. This market can be categorized into two types: strong bullish and weak bullish. In a strong bullish scenario, the price rises rapidly, making higher highs with significant increments. This rapid increase indicates strong market momentum and suggests a potential continuation of the trend. In contrast, a weak bullish market sees the price still rising but at a slower pace, with smaller increments between higher highs. While the market remains bullish, the weakening momentum may signal a potential shift, consolidation, or reversal. Similarly, in a bearish market, the overall sentiment is negative and prices are generally declining. This market can also be divided into two categories: strong bearish and weak bearish. In a strong bearish phase, the price drops swiftly, creating lower lows with significant decreases. This sharp decline indicates strong downward momentum and often suggests a continuation of the bearish trend. Conversely, in a weak bearish phase, the price continues to fall but at a more gradual pace, with smaller reductions between lower lows. While the market remains in a downtrend, the diminishing momentum could indicate a potential shift, consolidation, or a change in trend direction. These types of market conditions occur frequently. Understanding them is crucial for assessing the strength of a trend and anticipating potential changes in market dynamics. RSI can simplify this process by providing clear insights into momentum shifts. In the chart below, we see an uptrend market experiencing a loss of momentum. By analyzing the highs and lows, it becomes evident that the upward and downward phases of the market are becoming inconsistent. Initially, there is a sustained price rise, indicating a gain in momentum and resulting in a relatively high RSI. After a brief pullback, the price starts to climb again, but this time it's only a short-term rally. Traders are no longer as enthusiastic, and the upward movement lacks the strength seen in the previous surge. As a result, the price begins to struggle, and the RSI may not reach the same levels as before, signaling a potential weakening of the trend and a possible shift in market dynamics. The example we just covered illustrates RSI divergence. RSI divergence occurs when the price and the RSI, or momentum, move in opposite directions. We can categorize this regular divergence into two types. In a bearish divergence, the price forms a higher high, as indicated by points 1, 2, and 3. While the RSI forms a lower high around the same time. This pattern suggests that even though the price is reaching new highs, the momentum is losing steam. This weakening momentum hints that buying pressure might be cooling off, and a bearish reversal could be right around the corner. Conversely, in a bullish divergence, the price forms lower lows while the RSI forms higher lows. This signals that despite the price making new lows, the momentum is improving, which could suggest a potential bullish reversal as selling pressure wanes. To keep it simple, here's how we illustrate the behavior of price and RSI. In each scenario, you'll see that while the price moves in one direction, the RSI moves in the opposite direction. Now, let's dive deeper into bearish divergence. In this section, we'll explore several examples to see how this pattern unfolds and discuss the key conditions for entering trades based on bearish divergence. In the first example, the price initially rises at a significant pace, leading to a high RSI. It then encounters a minor pullback before climbing again. However, this second rise, despite reaching a new high, shows a decrease in momentum. The RSI confirms this by being lower than during the previous ascent. This forms a bearish divergence, suggesting a potential reversal, and the price starts to move downward. Similarly, in this example, the price rises sharply, pushing the RSI into the overbought zone. After a brief pullback, the price climbs again, but at a slower pace. Despite reaching a new high, momentum weakens, resulting in a lower RSI. This bearish divergence suggests that, while the price is still rising, the underlying strength is fading, indicating a potential reversal. Please note that not all bearish divergences perform as expected. To improve the success rate of trading, we can apply additional rules. First, the price should form a higher high while the RSI forms a lower high, establishing a bearish divergence. Next, for this strategy to be effective, the RSI should enter the overbought zone during the first high, indicating strong momentum. Then, during the second high, the RSI should exit the overbought zone and return to a more moderate level. This shift illustrates a loss of momentum and increases the likelihood of a price reversal. On the other hand, if the price makes a higher high but the RSI remains in the overbought zone, the bearish divergence strategy becomes less effective. Even though the RSI forms a lower high, satisfying the conditions for bearish divergence, the continued presence in the overbought zone suggests less momentum loss, and the price may not reverse as expected. Let's examine an example to illustrate this concept. At peak number 1, the RSI is not yet in the overbought zone, so we disregard it. When the price rises sharply to the second peak, the momentum is strong enough to push the RSI into the overbought zone. We note this point as it sets up for potential divergence. After a brief pullback, the price rises again to peak number 3. Although the price reaches a higher high, the RSI shows a loss of momentum and exits the overbought zone. This forms a bearish divergence. Before entering a short trade, we should wait for the price to reverse downward. One effective technique is to draw a trend line connecting the lows. Once the price breaks this trend line to the downside, it's a signal to enter a short trade, anticipating further declines. Another example illustrates a similar concept. Initially, the price rises strongly, pushing the RSI into the overbought zone. After a brief consolidation period, the price rises vigorously once more. At peak number 2, the RSI remains strong and in the overbought zone. We do not enter a short trade at this point, as the price may continue to rise further. Instead, we wait for the price to make a new high, while the RSI forms a lower high. At peak number 3, the price loses momentum, and the RSI exits the overbought zone, creating a perfect bearish divergence. To enter the short trade, we draw a trend line connecting several lows. When the price breaks below this trend line, we enter a short position. As anticipated, the price declines following the bearish divergence. Now let's shift our focus to bullish divergence, a signal indicating potential upward reversals. We'll explore how to identify this signal, the conditions required for its formation, and how to use it to make informed trading decisions. On the chart below, we see a prolonged downtrend with several pullbacks. After a series of downward waves, the price reaches a low that coincides with a similarly low RSI. The price then experiences a deep pullback before resuming its decline. However, this downward move is less severe than previous ones. Despite the price making a lower low, the RSI shows increased strength, moving higher. This creates a bullish divergence, indicating a potential upward reversal, which aligns with the price reversing upward as expected. Likewise, this example illustrates the same concept. We start with a strong downtrend, marked by a low in price that corresponds with a low RSI. After some time, the price dips further, creating a new lower low. However, this new low in price is not matched by the RSI, which shows a higher low instead. This divergence between the price and the RSI signals a potential bullish reversal, suggesting that the downward momentum is weakening and the price may soon begin to rise. Similar to bearish divergence, we can enhance the success rate of trading with bullish divergence by following specific guidelines. First, the price should form a lower low while the RSI makes a higher low, creating a bullish divergence. For this strategy to be effective, the RSI should enter the oversold zone during the first low, indicating weak momentum. During the second low, the RSI should move out of the oversold zone and return to a more neutral level. This change in RSI suggests a rebound in momentum and increases the chances of an upward price reversal. Conversely, if the price makes a lower low but the RSI remains in the oversold zone, the bullish divergence strategy is less effective. Even with a higher low in the RSI, the continued presence in the oversold zone indicates weaker momentum recovery, and the price may not reverse as expected. Let's look at an example to illustrate this concept. The price drops sharply to reach point number 1, which corresponds to the RSI entering the oversold zone. After a brief upward pullback, the price declines again, but with less momentum this time. Although the price makes a lower low, the RSI starts gaining strength and exits the oversold zone, moving back into the moderate range. This scenario indicates a bullish divergence, signaling a potential reversal to an uptrend. At this stage, we do not enter the trade just yet. To confirm an upward reversal, we draw a trend line connecting the recent highs and use it as a reference. However, after a prolonged wait, the price fails to break above the trend line and instead makes a lower low at point number 3. Since the price did not break the trend line, we disregard the previous bullish divergence and look for a new one at this point. The price and RSI form a new bullish divergence, prompting us to repeat the same process to set up a trade. We draw a trend line that connects as many highs as possible. Once the price breaks above this trend line, we enter a buy position, anticipating a rise in the price. In the next example, we see a similar situation with a continuous downtrend marked by several pullbacks. At the first low, the RSI dips into the oversold zone, showing significant weakness. We then wait for a bullish divergence to signal a trade entry. When the price reaches a lower low at point number 2, we check to see if the RSI shows signs of strengthening. However, the RSI remains in the oversold zone, indicating that upward momentum is still weak. At point number 3, the price hits another lower low, but the RSI still struggles, clinging to the oversold zone. Then, the market takes us to the trough at point number 4. This time, things are different as the RSI starts to gain traction and pushes out of the oversold zone, signaling a bullish divergence. We then enter the trade after the price breaks above the trend line, anticipating an upward surge. Our final example for today's episode demonstrates a short-term trading strategy using RSI divergence in conjunction with chart patterns. At point number 1, the price drops sharply, pushing the RSI into the oversold zone. We mark this point as our support level. The price then reverses upward but falls back to the support level, creating a lower low. As the RSI exits the oversold zone and starts to rise, it confirms a bullish divergence signal. Additionally, the price forms a double bottom chart pattern, complemented by several long wick candles, reinforcing the bullish sentiment. We can confidently enter the trade with the next significant green candle. That sums up our look at RSI divergence. We covered how to spot bullish and bearish divergences, confirm them with chart patterns, and use them to make informed trading decisions. Thanks for watching. If you find this episode useful, subscribe and hit the bell for more updates. Drop your questions and comments below, and we'll see you in the next episode.